Good afternoon. My name is Ken Crabb. I am the creator and founder of the Restricted Property Trust. Today is February 18th, 2019. Today's presentation is not designed to replace our more technical presentation that's also longer. That presentation is almost 50 minutes, but in that presentation, I go through the history of the Restricted Property Trust, how it came to be, a lot of the technical tax authority. It's really ideally suited for sophisticated financial planners, attorneys, and CPAs, definitely not for clients. And I go into all of our audit history. Today, I am just going to dive right into 3 case studies as a supplement to that prior presentation. And I've recorded a lot of presentations. The one from 2017 is still our favorite. Seem to get a lot of the information in, and it's well under an hour. It's just over 50 minutes. But today I want to finish up in about 20 minutes and just walk you through 3 cases. I will tell you that as February 18th, we have 19 years of history now for the Restricted Property Trust. We are entering our 20th year. And one of, I think, the reason for the explosive growth of the Restricted Property Trust over the last 2 or 3 years, aside from all of our IRS success, is that it's really becoming far more commonplace in the market. The Restricted Property Trust is less seen as an advanced tax planning tool and just kind of a tried and true employee benefit trust. And that probably explains why we're up over 1,800% in the last 9 years. But today is going to be different. Again, this is, if you've not viewed our previous more technical presentation, you want to take a deep dive, please feel free to jump in there and do that. We can send it to you. But today I'm going to cover 3 different cases that we completed last year, just 3 different case studies. And I want to dive right into those today. I will say that when I get on the phone with a client, I typically just walk through the 3rd page of our 5-page proposal. I say, hi, I'm Ken Crabb. I've been doing this for almost 20 years. We have 100% IRS track record, and here's what the plan can do for you. It's very, very efficient in its presentation. One of the other things I will say, so many of the advisors that we work with always request proposals, which is great. We love a request for proposal. When I'm meeting with clients personally or talking to them on the phone, I much prefer to use samples because the underwriting isn't done yet. I haven't looked at a corporate tax return to talk about what I can actually do for them with the Restricted Property Trust. And so I much prefer to not set any expectations until I've looked at a corporate tax return and until we have underwriting completed. So I tend to use a lot of samples. But this sample here, this is a 52-year-old male. This is a successful business owner. And when you request a proposal from our office, this is what you're going to get. You're going to get this little cover page that kind of talks about, hey, here's what it is. What are the objectives of the RPT? Here's a little summary flow chart. Some people tend to gravitate to this. I do like the number down here where we talk about immediate tax efficiency, because everybody in the United States is looking for, well, probably all over the world, looking for instant gratification. And you will instantly have some tax mitigation when you participate in a restricted property trust. But tax mitigation isn't the be-all, end-all. We've got to look at the overall economics. So this was a successful business owner. This is our most common scenario that we run into. This is an individual that owns a high cash flow S Corp and was initially just looking for more deductions. And I took a look at their tax return. They were a preferred non-smoker. And we look at this from a key man life insurance perspective, because keep in mind, if I get on the phone with the Internal Revenue Service, I'll never tell them, hey, yeah, we did it because the client called me and said he wanted a really big deduction, because obviously that does not represent a business purpose. So what business purpose are we achieving that allows for an ordinary necessary business expense? And in this case, it's to provide a death benefit for continuity. And that death benefit amount needs to be reasonable. So if this client has a $5 million business, I've got $1.5 million of death benefit here. That's very easily reasonable. But if this client called you back and said, hey, I want to put in $400,000, well, now all of a sudden, we're talking about a $12 million death benefit. And there's no way that we could tell the Internal Revenue Service that his family might need up to $12 million to continue this $5 million business. That doesn't make any business sense. So I just want to let you park with that limitation that I run into very often, because the one thing the Restricted Property Trust has to do is it has to make sense. One other thing that business owners get immediately excited about, not just obviously the tax mitigation, but also the fact that we can fully discriminate. and we fully discriminate, it also makes sense. If the business owner dies, that is typically extremely disruptive. It's the most financially disruptive thing that could happen to the business. So what we did is we showed this business owner putting in $50,000 a year for 10 years. I make it very clear to the clients that this is 2 5-year windows. They are committing and locking it up for 5 years. And if they can't honor that commitment for any reason, if they can't fund the trust, then our trustee will literally forfeit the cash value and give it to charity. This is the thing everybody likes the least about the restricted property trust. It's also the reason that we are afforded the favorable tax treatment. Additionally, I think when you look at whole life insurance, no one should ever plan to fund whole life insurance for less than 5 years. It's just a bad plan. And so in this case, the restricted property trust, this business owner probably could have afforded to do $100,000, but they felt a lot more comfortable understanding that 5-year commitment and wanting to go 10 years. So we backed the premium down, and I would have been comfortable signing off on $100,000 because the death benefit would be just over $3 million. But here we scaled it back to have this be a very easy check for the business owner to write and not run into, with the hope of not running into the forfeiture provisions. And then I walk clients through the spreadsheet. I say, look, for you to put $50,000 into anything else non-qualified, you first have to make about $90,000. And then you pay your taxes, you have 50 left over. In the restricted property trust, because I'm generating on this $50,000, 35,000 of it is going to be net deductible to the client. So I really only need an extra $12,273 to cover those phantom income taxes on the $15,000. So in other words, I need $62,000 to get 50 into my plan. And then I just asked the business owner this question. If you take the same $62,000 home and your local banker calls you and says, hey, you're such a great client, we have a CD paying 8% fixed for 35 years. Wouldn't that be fantastic? And every business owner says that would be wonderful, of course. And if they took the same $62,000 home with no tax mitigation, they would have $34,000. And if they invested that and they made 8% a year for 10 years, in year 11, and I'll show you why I'm picking year 11 here in a second, they would have $456,000. In the restricted property trust, you see that we have well more than that after 10 years, but we do have a tax bill. And everybody asks me, how is this tax calculated? It's wherever the base policy premium contributed to this $518,000. So you can see in the first 2 years, we've picked up $15,000 as income. So in year 1, that $35,000 didn't contribute to the cash value at all. In year 2, it also didn't contribute to the cash value at all because the $30,000 of paid up additions had some growth. So if your client went to get this policy after the second year, which they can't do, but if they could, they would get a 1099-R that states fair market value $31,053, taxable portion 0. And we didn't cheat the IRS a nickel because the $70,000 that we've deducted so far has all been going out to mortality reserves. That's how whole life works. That's why it works so much better when you fund it for longer. But eventually that $35,000 starts to kick in pretty fast. And you can see the cash value after the second year starts ramping up. By the time you get to year 4, the cash value is going up by more than the contribution every year, which is why $100,000 is going to be the tax amount. And then I say to the business owner, look, if you don't need the life insurance anymore, you're retired, your kids are up and out, whatever, let's take a look and see how much income we can generate in the restricted property trust versus your bank account. So go ahead and look at the bottom of the screen there. If you made 8% fixed for 35 years, which everybody would be thrilled with, and I'm talking about safe money here, not private equity, not money that is more at risk. This is very safe money. This is whole life insurance. We can pull $821,000 out net of taxes. And in the restricted property trust, in the hypothetical fixed income account earning 8%, you could pull $775,000 out. So we covered this client's key person death benefit need, and at the same time, we outperformed an 8% rate of return. I will tell you that most clients get to the end here and they don't want to drop their death benefit. But I tend to show it to them this way because it's easier to sell it. And again, I say that directly to clients. But once they get this $2 million in death benefit, more often than not, they say, I really like to keep, they're emotionally attached. And so that's what tends to happen. So this is a 52-year-old business owner. Again, key person, very, very simple. And really what I've found now that I'm in my 20th year of doing this for clients that we've had for 4, 5, 6, 7, 8, 9, coming up on 10 years, for a lot of them now before they roll out, they are less excited about the tax deduction that motivated them to do the planning. But the trick for good financial advisors and good accountants and good attorneys is to figure out how to motivate our clients to do the planning they need to do anyway. And the restricted property trust is exactly that tool. It is really and I tell clients, I'm going to use the tax deduction to trick you into doing the planning you should have done anyway. And what we find is 7 or 8 years later, they're like, wow, I love this whole life policy. It's growing just like I thought. It's really, really great. Oh, by the way, there's some tax advantages to it. That's nice as well. Let's jump right in here. This was a premium finance hedge strategy. This was a client that was 64 years old. They were getting, what were they getting? They were getting $30 million of premium finance life insurance. They were also a business owner. And my very simple pitch was, hey, premium finance is a great strategy. It's a wonderful tool. It is not without risk, as we all understand. So why don't we do $250,000 into a restricted property trust, completely unencumbered by the leveraged policy. So they really don't have anything to do with each other. But let's just do this as a sinking fund or a hedge. And look, at the end of 10 years, we'll pay your taxes out of it, but we can get $150,000 a year out, $3 million out tax-free. So if your financed policy is under any pressure, if the leverage is, the interest rates have not performed the way we wanted them to, we can go ahead and use this $150,000 to take all the pressure off of that premium finance life insurance for the client's estate planning. Another tool, I'll even go to the next page, but that's just a quick premium finance play. And that a lot of those are our most successful cases, because if clients understand, hey, the premium finance is a good idea for me, it does fit for me, but it's not without risk. Well, why don't we go ahead, and in this case, we were able to outperform a 7% fixed rate of return as a sinking fund. They ended up buying a little bit less life insurance with the premium finance up front to reduce that risk. And we have all this tax-free cash flow to take care of it. That was a great case from last year. Here's another one. We had a 54-year-old who had a very close friend that has sold him tons of life insurance. He was worth a couple $100 million. And most of our clients are not. Most of our clients are doctors, dentists, making right around $1 million a year is probably our average client. But we do obviously have clients that are far more make a lot more money than that. But here, it was a little bit of a different play. This guy was spending just over $150,000 a year on other universal life insurance coverage. And he had paid up some other good coverages as well, but he was still spending $150,000 a year. And I simply said to him with his advisor, hey, when you retire, do you want to keep paying your universal life premiums? Because right now you're scheduled to pay those premiums until you're age 85. He said, no, I don't. And he did not want any more life insurance. He was done with death benefit. This was never going to be another sale for my partner advisor. Well, what we did is we backed into this 150 number. Again, he had a very good corporate tax return. Me justifying that $5.6 million was reasonable for the business purpose that we were achieving was very, very easy. Frankly, I would have been willing to cover this guy at $15 million and defend that. But in this case, we were just trying to do an income solve. And I showed him, look, if you decide to hang your cleats up at 65, this RPT, not only do we generate some deductions for you today, help you give you a little bit of tax relief today. Yeah, you have a little bit more death benefit, but universal life, as you get into your 80s and they're taking out that 1-year term rate, can start to, if you don't fund those properly, they can get into some trouble. So let's go ahead and set this strategy up, and we're going to make sure that you pay that $150,000 a year on all of your other in-force coverage from age 65 to 84, so that your universal life block of life insurance that you're using for your family and your estate planning will absolutely be in force when you die. And so again, the restricted property trust in this case was just a mechanism, a source of future premiums for their existing block. So I've shown you a premium finance hedge. I've shown you a case study. One other thing I didn't get into today in this meeting, but buy-sell agreements, those are my favorite because we have a very, very concrete business purpose. So anytime we have multiple owners, it's probably a third of our cases are buy-sells, and that's perfect. One partner dies, the other partner has to redeem the shares from his deceased partner's spouse, and we get a step-up basis on death. And the restricted property trust is a wonderful way to cover that. Final case we'll take a look at today. We had an extremely successful gal that was an entrepreneur and just cranking it out. Huge brand, very successful. She was also in the middle of lots of other life insurance coverages. She needed about $100 million of life insurance. Obviously, mid 40s here, so great case for us. And what drew her to the restricted property trust is there's so much going on in her business, and there's other investment risks that she's taking, and the whole life insurance play is just very boring. And so the idea of just generating an 8% fixed rate of return, of course, protecting her brand. If she dies, her family would get this $24 million, and they would have the opportunity to continue her various businesses. But in this case, we are also doing it as asset allocation to say, yes, the death benefit's absolutely reasonable. But if you live 10 years, this is boring whole life. This is not, again, it's not your private equity option portfolio. It's not some of those other things that you're doing that are very aggressive and have worked out very well for you. I'm not here to beat those up at all. It's part of the reason you're so successful. But here's a rainy day money. This is safe money. And with safe money, you can see not only at her age, and she was also very healthy, if she earned 8% a year on a fixed income portfolio, she would be able to take the same amount of money home and pull $7.388 million out. In the restricted property trust, we didn't beat an 8% rate of return. We crushed it by providing her with over $3 million more of income, because you can see our $520,000 is able to maintain all the way for 20 years, whereas it only goes through about 15 years on the other side. So that is another case, again, very successful entrepreneur that we've gone through. And the biggest thing, clients, when they look at this spreadsheet, the question simply becomes this. I understand the 5-year risk of forfeiture. I understand that this requires 2 separate 5-year commitments. So please know, this is not a 10-year commitment. This is 2 separate 5-year commitments. I usually like to show the 10-year spreadsheet because whole life insurance looks prettier the longer you fund it. But really, they're just looking at this spreadsheet saying, is this rate of return worth it to me for a very stable, boring investment? Is it worth it for it to be very illiquid, to lock up my money in 5-year rolling windows to achieve 8%? And most of these clients that have their money in cash and bonds, they're making somewhere between 1% and 4% a year. And they're saying, for a 400 to 700 basis point increase in my overall rate of return, I am willing to lock my money up in 5-year rolling windows to achieve this wonderful result. And I will say very quickly, we'll have business owners look at a spreadsheet like this at 500,000. I was doing this for a client in construction in the Midwest, and he said, 500, it seems like it should be an easy number for me, but I really want to know I can fund it for 10 years. So I'm going to back it off and just do 300,000. And my job is not to tell the client how much to put in. My job is to tell the client how much I will let them put in based on their specific facts and circumstances of their corporate tax return. But these are 3 case studies. Again, I walk all the clients through that every time on the phone. If you're still interested in the, all the technical, a little bit boring, feel free to request our prior technical historical go-to meeting that lasts about 50 minutes. We also have a proposal request form. You're more than welcome to send me. It's right here. I do ask for a lot of information, but please know that I really do like presenting initial presentations with samples, because if I don't have the client's corporate tax return and I don't have their underwriting offer, whatever we show the client is a sample anyway. I don't want to give them the impression that I'm showing them what their restricted property trust would look like over the next 10 years when I don't have a corporate tax return and I don't have an underwriting offer. So we do ask for a lot of information when we get to the actual proposal stage. I do ask for page 1 of the entity's tax return, because I certainly can't make you guys any promises that we can put 100, 200, 300,000 in until I know what that corporate tax return looks like and what we would see as reasonable for the business purpose that the business is trying to achieve. So thank you very much for taking the time. Hopefully this will help you for 2019, more case ideas, and have a great day.